BlackRock has just issued a warning for investors, saying that most investors are wrong when it comes to predicting what the Federal Reserve Bank is going to do in 2023. Let me read you this headline from an article that CNBC published today. It's titled, BlackRock Warns That Investors Are Making a Mistake by Betting on the Fed to Cut Interest Rates. Now, if you've never heard of BlackRock, they are one of the largest investment institutions in the world. They are investing about $10 trillion worth of assets, not 10 billion, $10 trillion worth of assets. And essentially what they're saying is that they don't believe that the Federal Reserve Bank will or should cut interest rates in 2023, and that you have all these investors on Wall Street that are trading and betting on the idea that the Fed is going to start cutting interest rates in 2023. And this is where BlackRock says you are wrong and you're going to lose money because of that. And then BlackRock goes on to say that, do you even understand what it means for the Fed to start cutting interest rates? Because in this article, I'll discuss it in just a minute, but BlackRock is essentially saying that if the Fed was forced to actually start cutting interest rates, you're going to have much bigger problems on your hand, and you're going to be even more wrong about asset prices and stock prices and the economy. So let's dive into the article. And I want to start by reading you the first line from the CNBC article. I'll also link this article for you down in the description in case you want to read it for yourself. But the first line of this article is, investors are too confident that the Federal Reserve Bank will cut interest rates this year and they could pay the price later. The Federal Reserve Bank is the central bank here in the United States, and they have the power to cut interest rates or raise interest rates. And up until now, for the last year, the Federal Reserve Bank has been working aggressively to raise interest rates as a way to bring inflation down. And essentially, now we're at a point where interest rates have gone up so much that borrowing money has become more expensive, that a lot of people are now betting that the Fed will start cutting interest rates. And so they're trading their money in the stock market, hoping that the Fed will start cutting interest rates. And this is where BlackRock says, no, you are wrong, and you're going to lose money because of that. Why? Because, well, they think that if the Fed had to cut interest rates, you have much bigger problems on their hand. Let me read you a second quote from BlackRock. What they said is, the Fed could only deliver the rate cuts priced into the markets if we see a more serious credit crunch or a deeper recession than what we expect. So, the Federal Reserve Bank is working to raise interest rates to induce a mild recession, a small slowdown in the economy. This is what the Fed is hoping for. They call it a soft landing. And this is where now BlackRock is saying, if the Federal Reserve Bank had to cut interest rates, do you realize what would force them to cut it? According to this article, it is either a much bigger credit crunch, aka a bigger banking crisis, or two, a deeper recession than what we thought. Because the traditional way that banks fight, or the central banks fight inflation, is by raising interest rates. And the way that central banks fight a recession is by cutting interest rates. Because when you see a slowdown in the economy, we saw this happen many, many times, the Fed starts to cut interest rates to make it more easy and attractive for people to borrow money. And we saw this happen in 2020, 2008, 2001. The Fed cuts interest rates. People go out and start borrowing money. They start buying cars. They start buying homes because it's cheaper to borrow money. And this boosts the economy. But it can also cause higher inflation. And this is what BlackRock is saying, that if the Fed were to start cutting interest rates now, that would mean that we have to have a much bigger credit crisis or a much bigger recession than what we expect, in which case that's going to hurt stock prices even more. Not because of interest rates, but because of how painful that would be for the economy. And that's where BlackRock is saying that a lot of traders are not understanding really what they're pricing in, because traders are pricing in rate cuts. But they're not understanding that rate cuts mean a much bigger issue for the economy, and that's where BlackRock is betting their money, and I'll talk about what they're doing in just a second, but this is where BlackRock is betting their money, because not only do they think that these traders are wrong, that the Fed is not going to cut interest rates, but also if and when that pain happens, that they're not positioned in a way to protect themselves or make money from a bigger slowdown in the economy. Now, we've been covering all of this in market briefs which is my free financial newsletter. If you haven't joined Market Briefs yet, it's a free and easy way for you to stay up to date on what's happening in the financial markets, the banking sector, the housing market, the stock market, crypto, and the global economy. It's a super brief and fun to read email. You can read it in less than 5 minutes every morning. So if you want to join Market Briefs, it's free. And I got the link to how you can join for free down in the description below. This is where the article gets a little bit interesting because they brought in then Bank of America, and they give Bank of America's opinion on this because Bank of America agrees with BlackRock, and they talk about how they are now advising their investors into their banks and institutions. And what Bank of America said is first that the US stocks are looking past the type of economic slowdown that will be required to get the Fed to cut interest rates. AKA, kind of like what we've been saying, that the people who are betting on interest rate cuts don't understand the amount of economic pain we would need to justify interest rate cuts. So if we see interest rate cuts, that's going to be even bigger problems than what people are expecting. Second, this is the more important part. Bank of America says that there's two important things that you need to understand. Number one is that recessions are reliably negative for equities throughout history, aka recessions cause stock prices to go down. Number two, they say that the Federal Reserve Bank projections about interest rate hikes and cuts imply that we're going to see no rate cuts even if we get a mild recession. So the Federal Reserve Bank is saying that they don't plan on cutting interest rates even if we see a mild recession, meaning that the Fed only is implying that they will cut interest rates if we see a major recession or a much bigger credit crisis than what we're seeing right now. So now tying this together, Bank of America and BlackRock both agree that the Federal Reserve Bank does not have any plans to cut interest rates in 2023, while you have a lot of people who are betting with their money that the Fed will start cutting interest rates. This is where Bank of America and BlackRock are saying that essentially stocks are overvalued because of that. And then they're going on to say that the people who are betting that the Fed is going to cut interest rates don't understand what that actually means. Because if the Fed is forced to cut interest rates, that means that we're facing a much bigger recession or a much bigger credit crisis, meaning much more pain to the economy than most people expect. And if we see that bigger pain to the economy that would justify the higher interest rates, the cutting of interest rates, that would mean that stock prices would have to go down, because what we've seen throughout history is that recessions cause pain to asset prices, and that would push asset prices lower. So the people that are trying to bet that the Fed is going to cut interest rates are wrong in a lot of different fronts, and this is where you have Bank of America and BlackRock agreeing on this. And the last line of this article, which I think is important to understand, says, like BlackRock, Bank of America is advising clients to bet against US stocks and instead focus on strategies that pay when the market fails. So that's what BlackRock and Bank of America are saying, is that they're telling their clients to move their money out of US stocks and go into more risk-on strategies that will pay if we see more pain in the economy. Some of these include investing in international companies, into emerging markets, into assets that pay a fixed rate depending on where inflation is, in short-term bonds. These are the things that the article mentions where BlackRock is advising their clients to go. Now, I do got to let you know, I'm not a licensed financial advisor. I'm not here to tell you what to do. I'm here to keep you educated and informed, so understand that investing has risks. Never blindly follow a random guy on YouTube. Always do your own research. And now let's talk about the education of what this means, because there's a lot of different ways that you can invest your money. And this is where now you, as a financially savvy investor, want to grasp this information and not just blindly start panicking and make emotional decisions with your money, but now understand what your options are. Because the way that you invest your money, your strategy is going to dictate what you should be doing. Because if you're just a passive investor and you're dollar cost averaging into the S&P 500 index, into the stock market, then none of this matters, because you should just continue dollar cost averaging for the long term and let the next few years happen and just keep doing your thing. And if we see more economic pain, you just buy more. So if you're just a passive investor and you're dollar cost averaging, you do not change anything, because the way you win as a passive investor is by investing for the long term. If now you're a more active investor, I'm not talking about trading because I don't understand trading. I'm not a trader. That's gambling to me. If you are an active investor, where now you're looking for individual investments, whether it's stocks, whether it's real estate, that means, according to this information, well, you want to be, again, pickier and patient with your investments, because if the Federal Reserve Bank continues to raise interest rates, it's going to continue to put downward pressure on the economy. It's going to continue to put downward pressure on asset prices. And this is where now understanding the different options, because we have the opportunity to invest in companies and countries overseas, and that poses another opportunity there. And just being patient and understanding the risks, because you have some people that are bullish that think the market's going to go up. You have some people that are bearish that think the market's going to go down. And the saying on Wall Street is bulls make money, bears make money, but pigs get slaughtered. You can make money if you think the market's going to go up. You can make money if you think the market's going to go down. But the people that lose money are the people that get greedy. And this is where now just understanding the different opinions out there, do your research and be picky with your investments. And now, if you're not an investor yet and you're wondering now how do you capitalize on opportunities, the first thing right now is understanding that, hey, we're going to go through a pain period in our economy. Whether you believe it or don't believe it, prepare for it, because the reality is these higher interest rates are going to have an effect on our economy. That means you want to live smaller now. This is not the year to finance a brand new truck. This is the year to get financially smarter, live below your means, work to earn more money, and have a cushion that way you have money to invest, or you're actually investing your money. Now, where do you invest your money? I have a ton of videos on my channel. I don't want to turn this into an hour-long video going into the different ways that you can invest your money. You can watch some of the other videos on my channel to learn how to do that. But now understanding that it is so crucial to build that financial education. That way you can use your money as a tool, instead of just spending all of your money and then seeing more economic pain happen, and then you have no money to protect you and you have no money to capitalize on purchasing distressed assets at a discounted price. So understand now that you have these warnings coming up from BlackRock, got the same warnings coming up from Bank of America. Understand how they're advising people. Don't blindly follow them or me or anybody. Understand what they're doing. That way you can use that education to your advantage, instead of being the one that gets hurt by the system.